Well, Michael, thank you so much for returning here to F.A.C.E. I'm passing you the controls now, my trading warrior brother. Just waiting to hear your voice, see your setups in here, see your screen.
Can you guys hear me?
There we go. There we go. Got it, Michael. How are you?
I'm doing well, sir. How are you?
Good. Thanks so much for coming back. You know, your reputation precedes you. One of your fans commented in here, when's Michael coming on? You guys are boring. So, so, you know, a lot of love out there for you. You know, you set such a high bar for, you know, amateurs like me, you know, that it's great to have you on my reality TV show. So,
to be here again.
Also, Michael, you know, I interviewed quite a few people that acknowledge that they learned a lot that has helped them in the markets from you. So, you know, it's always interesting when, you know, during interviews, I ask, you know, who influences you or who did, and your name comes up. So you've been paying it forward for a while to a lot of people. So great mission, man.
Thank you. Appreciate that.
Okay, so let's get to the Dixie. And I wanted to start off with this question because I forgot who it was. I think it may have been Crypto Cred. Talks about how I said Michael likes to look for where the liquidity is, and he said, yeah, where the orders are. How do you know where the orders are, buddy?
That's one of the hardest questions to answer in like one sitting, because there's a lot of things to study, and it's not. I'm not trying to veil it or like dangle it with a carrot or anything like that, but yeah, there's some things, and you're not a young guy like me. I mean, we've been around for a while, and there's a lot of things you have to learn about the markets and yourself, and you have to lose a lot of money apparently to learn, you know, the most important lessons. The things that I think that are paramount to understand where liquidity is. Well, there's a few of them in this chart where I'm going to talk about today, but okay, if I can just get right into it, it'll help me answer that.
All right, buddy.
But the last time we spoke was in February. I mentioned that there would be some measure of a move above this high, and your listeners and such can go back and look at that.
Yeah, I remember you were bullish a euro, and it popped pretty good. You know, a couple of days after the broadcast.
Well, there's two specific. There's a lot more different reference points in terms of defining liquidity, but there's two that I like to teach initially because they're easy to see for a retail trader, for someone that's like a neophyte. I don't have a lot of experience with starting. The one that I like to teach is the equal highs and the double bottoms. Okay, because retail traders are indoctrinated to think that these are support and resistance, and they may appear so initially, but large institutions will target them at a later time. Now, the variable is going to be an unknown. I don't know how much time is going to be between where the market is and where it's going to go to these points of liquidity, and I'll draw out one right now. If you look at these highs here, okay, there's equal highs. People that have been following me for months now know that my eye has been set on this area right in here. Now, specifically, there's a price point right above those that is proprietary, but you don't need to know that. You don't have to be so precise. But whenever we see equal highs, okay, or equal lows, that to me is like a big billboard sign, flashing neon sign, like there's stops above these highs, and equal lows, there's obviously sell stops below those.
Right.
If you go back and look at price action, and it doesn't matter what time frame you use, it's universal because everything in price is fractal. If you look at periods where there are clear, discernible equal highs and equal lows, invariably the market will go back to those reference points and sweep them to some degree. There's a benefit in studying this because not only do you understand where the market's most likely going to go next, because the market always seeks the side of the marketplace that has not been traded as efficiently. Okay, and last time we spoke, I kind of delved into what inefficiencies are.
Does that kind of go along with, Michael, like, you know, my expression that the market will shake out as many participants as possible before the move they're looking for happens, then most likely without them?
Absolutely.
Okay.
The market's not an ATM machine. They're going to take your order if it's available, and they'll unseat you and take your seat, and then the move will take place.
Okay.
Retail traders generally will not have the moxie to get back in if they are knocked out, and it's like it feeds on itself. It's trader psychology. No one likes to get stung twice, so it's hard for a trader to understand this. And the best way to teach yourself is go back and look at price action in the past, look at equal highs and equal lows, and see how price sweeps them. You'll get a lot of insight based on the mechanics of what price does after it runs these levels. For instance, I've been mentioning for months now that we're going to go up to this level here. We've done so. We've swept it. Now, obviously, this is marked for end of day data, and we've gone just a little bit lower than the candles shown here. And I'll give you my prognostication, what I think may happen going forward. But for now, just notice that we swept it 3 candles and went above it. This one here, we rejected that.
Right.
That in itself is what I try to teach neophytes in the beginning, because when price is down here or down here or down here, this is going to be a magnet for price. This is like the question is where's the market going? And I always make fun of the pundits will say, we can't time the market. Well, we do it all the time. Every week, it's pretty much consistent. I'm not always right, but if you look at price like I'm explaining it here, on a higher time frame like a daily, it removes all of that uncertainty and vagueness that permeates the marketplace in terms of education. We'll throw a whole list of indicators on the chart, and you can't even see price. What I like to do is look for where the orders would be residing. Now, when I ask myself internally, where's the buy stops, where's the sell stops, I'm not asking that in a sense where am I going to hurt myself as a trader. What I'm looking at is where's
the market going?
Exactly. And I teach that as the draw. It's a draw on liquidity. And if you do that on a daily chart, generally you're going to have your bearings in the right direction. Now, the hard part is getting caught up in the short-term volatility of intraday trading. You look at a 5-minute chart, and any one of these days here that is a down closed candle could have very easily talked the trader out of expecting the market to reach to here. So you have to develop a certain measure of conviction, and you only teach yourself that from experience. And no one can transpose that from like you, and you've been around for a long time. I've been around for a number of years. We can't just take what we know as routine things and submission to things that we've learned over experience. We can't place that in other traders.
It takes time, the tincture of time, right? I mean, and in our business, it's screen time, right, Michael? I mean, you can't learn experience. You have to put in the time.
Right. You can't do it from books. You can't do it from watching a video. You have to put yourself in front of the charts and study it. But that's one of the easiest things for me to outline to someone that doesn't have a lot of experience. And even folks that have been trading for a long time, once they understand this principle, it's good. Price moves based on its seeking of liquidity, because the market is not moving on an indicator base. It has no respect of your trend line, it has no respect of your Ichimoku, Fibonacci zones, all these things. They're distractions. And if people would just strip their charts down and look for periods of where the real actual orders are, because price isn't going to go up based on the list of things that we have on our platform. Indicators aren't going to do it. What makes the market move is this.
How about ever try and use a magnet on your screen?
A magnet?
Yeah, you put a magnet and drag it in the direction you want the candle to go.
Yeah, there you go. The purpose, I think that the benefit rather of having an indicator is to see what the multitude are expecting. And I kind of like to use it as a sentiment gauge. So if I see a lot of ideas that would be viewed in the indicator realm, suggesting that price would be internalized as bullish, and I'm looking for an area below the market, for instance, like these equal lows here, okay?
Yeah.
I have that on my notes as if we have a deeper retracement and we lose this level here, okay? This down close candle, to me, and by my definition, this is what I call a bullish order block. What makes it a bullish order block is because we had a nice expansion, displacement of price, and it took out a high. Now, even though this was my initial target, I'm not trying to pick the top, okay? And I'm going to give you something today for your viewers so you can study and go back and see if I'm giving you anything of any value, and also you can kind of test it going forward. The things I talked about last time we were discussing live with the markets in February, I gave you some scenarios of what I was anticipating here. Obviously, the run above here and return back to this low here. It's not standard support resistance I'm focusing on. I'm focusing on the liquidity that rested above here. And you asked me what would negate certain things. I counsel you to go back and look at that video, because the things I kind of outlined is happened already. So I'm going to give you another sample of what I think is going to happen going forward for the next couple months, and we'll see if I'm right again. But
okay,
I gave you some criteria about if the market was able to stay above this low here. I'm sorry, not that low, this candle here. What I was basing that on was the order block, which is this last down close candle. Okay, so if it stays above that, it's respecting that. That means the institutions that bought here, that broke this high here. Now remember, go back and watch that video, because I was suggesting that price was going to sweep here. Now, I did not know if it was going to have a long-term move up, because the conditions weren't there yet. The conditions were, as I'm going to outline here, so you can kind of use it going forward the next couple months as well. The liquidity that was ran above here, we see that. That's a break in market structure. This was after our meeting. So when market repriced down to this level here, there's a bullish order block. In this realm here, I'm going to pull up something that my students are familiar with. It's what I refer to as SMT, which is kind of like a quirky little name for smart money technique or smart money tool. All it is
like it.
Blending. Again, it's going to look like indicators. Once I put it on a chart, it's going to look like, oh, wow, he does use indicators. And I use four indicators. It's the open, the high, the low, and the close. I look at how the markets go through a period of accumulation and distribution. I don't need a MACD to do it. I don't need a stochastic to do it. And none of your viewers, and neither do you. You don't need any of these things. If you know what you're looking for and you blend time and price theory. Time is obviously, with Forex, we're very susceptible to fluctuations and increased amount of volatility volume.
Not being patient.
Well, not so much that. What I'm trying to draw the allusion to is there's no other market that is more time sensitive, in my opinion, than Forex. I mean, you can set your clock to some of the things that are very generic with price action. Like there's certain things that have a high probability to create a higher low in the week on specific days if certain criteria are there. Now, without going into all that, because I could literally talk to you for 24 hours and not even scratch the surface on that. But what I want to give you is something to go away with, and your readers and watchers to go through their charts and kind of like get excited about looking at their charts naked, because it feels smart, it feels intellectual, and I used to do the same stuff, having all these things on our chart, but it's a distraction from really what price is trying to tell you. If you just focus on price itself, it'll give you all the insights that you would ever need and never have to look for that little indicator drop-down tab on your platform. You don't need any of those things. As soon as you start putting things on there, you're trying to justify reasons for price doing one thing or the other. And when you're not right, you're left feeling demoralized, because now you're left with, okay, does my indicator work or did I read it wrong? And neither one of those things are the real thing. It's that you're not watching price action. Price is telling you everything there is. It's giving you sentiment readings. It's giving you a directional bias. In fact, in the first couple minutes of me talking today, I've already taught you how to get the directional bias. If you look at your daily chart, find equal highs and equal lows, wherever that is in recent time and it has not traded there, chances are you got about a 70% probability it's going to go to that level. Why would it go there? Because that's where real orders are. I ask myself this simple question every single day when I sit down in front of my charts. Who's in the market right now making money? Where's their stop? That's the initial first draw on liquidity. And that's going to go by previous day's highs and lows. If yesterday was a bullish day, I know that there's going to be a large liquidity pool, which is basically another nickname for an area of stops. If yesterday was a bullish day, where's their stops going to be? Below yesterday's low. And yesterday's low, if yesterday's close was low, or if we had a down close day, then I know that the previous day's high, there's going to be a liquidity pool resting above that. So as a day trader or as a scalper, right away, you have something to go with and go into your charts and start studying that, previous day's highs and lows. So it's the first thing I taught on baby bets back in 2010. A lot of people discounted it, thought it was just, well, it's nothing of value, any value, but people that sit down with it and formulated trading plans off of it, they know exactly what they're doing day to day, just based on that simple little theory. And it took no indicators except for the open, the high, low, and close. Now, getting back to what's going on right now, because I kind of want to bring that, because I could talk and talk and talk and never really come to anything that goes forward. Last time I gave you an understanding of imbalances and what I felt was the most recent draw on liquidity, which was this high here, that we would try to reach up to this high, and then I don't know if it's going to break below this low. At the time, I was bearish because I didn't want to pick the bottom. The folks that follow me know that I changed gears in here and went bullish, and we were identifying initially these equal highs. See how clean they are?
Yeah.
Okay, right above that would be resting buy stops. why would there be buy stops there for people that have already went long? I'm sorry, not long, went short. To protect their short position, they're going to be having a buy stop here. Now, right away, retail traders are not going to see that as viable. It doesn't make any sense. Why would someone have a buy stop up here protecting a short that's already moved this far? Large funds do that. They have to have a certain measure of criteria where they allow the market to move, okay, and they have deeper pockets. They're not over leveraging their accounts like most retail traders are, and they can weather a pretty sizable retracement because they don't have the precision element on their side. They have a long-term macro view, and they are allowing these price cycles to move and gyrate around. And they have to give themselves a lot more room. Maybe they had some stops that were lowered to here, or maybe they lowered it to here. That's not my argument. My argument is you want to look for where there's periods of equal highs and equal lows. And initially, ours was here, and then it was here, okay? What I want you to focus going forward, and what I was looking for that wasn't in the charts yet, and I'll do that now, I look for an element of divergence. Everyone, I think, is aware of trading indicators. They know what divergence is. Price makes a higher high, but whatever indicator they use for measuring momentum fails to make a higher high, okay? And that's a simple understanding. And if you don't know what divergence is, a simple little Google search on it, and you'll know what it is right away if you're new. But if we look at the element of the dollar against, for instance, the euro, okay, and I'll take this off for a second. What I want to draw your attention to is the fact that we made a lower low here. Now, at the time of our discussion last time, it had already done this, but because I don't try to pick the very bottoms and I don't try to pick the tops, I wait for price to give me more insight. I'm going to teach you what I was looking for, and that way you can go forward and do the same thing going over the next couple months. And I think the same thing's going to happen. But this lower low here, okay, relative to this low here, in the dollar was not met with a higher high in the euro. Now, in classic understanding of market dynamics, if the dollar goes lower, foreign currency should rally, and if the dollar should go higher, foreign currency should go lower. It's like this teeter-totter effect.
So that was the divergence. The dollar was, the euro was not confirming the Dixie move.
Yes,
and that was your market tell.
Yes, that was my indication to watch for that run above that old high back here. Okay, because if it did that, what it's basically telling me is it's showing a willingness to break market structure, but I still would require more things. I'm going to teach you that, and it has something to do with these blue lines here in a minute. But the fact that the euro dollar was unable to make a higher high, what that's showing is it's a crack in correlation. Correlation is something that shifts in and out of the marketplace, and again, this goes in a deeper thought that you can't just teach in one discussion. But if you look at specific times of the year, specific times of certain months, certain days of the week, there's seasonality. There's tendencies for these things to repeat. Markets are not random. Okay, there's a lot of cyclical, generic traits and characteristics that.
Are you? Let me ask you, Michael. Are you a believer in turnaround Tuesday phenomena?
Oh, actually, yeah. I'm. If you look at the statistics, it's undeniable.
Okay. Because some people make fun of me when I bring up turnaround Tuesday.
Absolutely.
And I've had, I've said, Friday usually get follow through into Sunday, Monday, and usually your best reversal day is Tuesday, Wednesday, Thursday, but Tuesday being the preferred one. Yeah.
Yeah.
Okay.
Yeah, it's definitely something. Usually the people that make fun of it are the ones that are very highly indoctrinated in the one study or one approach, and they feel like they've conquered the world. I had that same problem too when I first started. They think they know everything. I thought I knew everything too, and then I realized I didn't know anything. But the lower low in the dollar, okay, the lower low in the dollar that was not met with the higher high that would normally be expected in the euro. If you're looking for indicators, if you start looking at price like this, especially for Forex, now it does the same thing with commodities. You can do the same thing with stocks. You can do all these types of things. But if you are specifically looking at trading currencies, this is one of the biggest insights that you're going to get in terms of understanding price action without the requirement of having an indicator. But you can feel satisfied that you have an indicator of some sorts because you're looking at a line. All this is the euro dollar plotted as a line chart. Now,
yeah, Mike, there is a kind of a recent example too NASDAQ 100 made new all-time highs last week, and the semiconductors peaked a month ago.
Right.
And they used to be the leadership. So NASDAQ making new highs without the semis is a message on NASDAQ.
Absolutely.
Yeah, okay. Go ahead.
If you look at what other pair would be inversely correlated or a mirror image of the dollar that's closely correlated to the euro, which one would that be?
Swiss?
Well, not so much, because that's actually
It used to be. So what is it, yen?
Well, it would be cable.
Okay. So I learned.
Maybe I asked it wrong, maybe threw you off. But if we include the British pound, if you remember, go back in our last discussion in February, you asked me about cable, and I said that cable was going to run its high, and it did.
Yeah.
That's that higher high. I said we were going to run this high. It did. Look closely. I'm not going to say anything right away, but do you see anything between the two charts at the top, the red being the euro dollar, I guess the yellow or orange being the cable?
Yeah, cable confirmed and the euro did not.
Now look closer. Look what's going on here. See this move here? It had a higher low in the dollar. Cable made a higher high, which I already told you that back here was going to happen. It was going to run this high here. Running that high was kind of like a false break. We already had the insights that it could have happened earlier than that, but it took this much time to get to it. This was the confirming factor I was looking for, because not only did the euro fail to make a higher high, the cable did make a higher high, but look what was going on with the dollar.
Gave it back in a hurry. It was like a false breakout, is what you're saying, over that 10% line.
Accumulation. The storyline behind it all is that the dollar was being a massive accumulation. It had already got the warning sign back here, but this is what I was looking for. Now, what was the driving factor behind me anticipating the move up to these equal highs and up to these equal highs here when it was in this area here? Seasonal tendencies. Okay, there's a seasonal tendency for the dollar index to move a prolonged period of time in the spring, and then moving lower generally July into October. Now, I don't want you to just take that, if you're a new listener, if you're a new trader, don't just get in there and say, oh, well, he said it's going to do this every year, so therefore I'm going to do it. No, you have to look at some things in price action to kind of like further validate those things. So I'm going to take these off because I think I've already made that point. If you look at the time between July and October, or September rather, going into end of September going into October, there's a very large seasonal tendency. And you go back over, I've been looking at data since the 80s, and if you look at it, there's a large seasonal tendency, or high probability, I should say it that way, for the dollar to go lower.
Yeah, 2017 bears that out.
Now, I can go back and show you the last 5 years, but I'm asking you all that are listening to go back and look at your charts too. There's going to be 2 times over the last 5 or so years where it does not do it. There's 1 year where it really rallies up, but if you look at the long-term charts, it should have never went lower anyway, because it had been moving lower for a long period of time. But seasonal tendencies are not panacea. They're not a be-all, end-all. They are not you hang your hat on and say
another tool.
Exactly. So it gives you a roadmap. So what I like to do is I look for periods where the market has a seasonal tendency for it to move, and one of the seasonal tendencies is for the dollar to rally in April, May time period. And then what happens again, we shift gears around July. So what does that give us? It gives us a roadmap every year to anticipate bullishness on the dollar, but the technicals have to line up too. So what are those technicals? The things I just showed you how to measure real accumulation, real distribution. If we can see that in the correlations between like markets, for instance, we've discussed the teeter-totter effect, where the dollar goes up, foreign currencies bend the knee and go lower. If the dollar goes down, foreign currencies are allowed to rally up. If we see that cracking correlation where there's a move that's met with a higher high in one and not the other in a reverse sense. In other words, higher highs should be seen with lower lows in foreign currencies. Dollar going higher, lower should be seen with foreign currency. All you're doing is reversing or comparing the extremes. If you do not see that, agree. What you're seeing is a cracking correlation, and the only way that would happen, and the only reason why it would happen, is there's such a large volume of accumulation or buying or selling that it has to manifest itself in price. This is the reason why I tell everyone, I don't fear teaching what I do because it's not going to stop. It's going to work forever because greed is what it is. Banks are not in the business. Large institutions, large prop firms, all these companies, their volume is such a huge volume. It's people don't understand how much money really goes through these markets, but their orders are not small. They're not tiny. They're very big, and they have to be broken up over blocks sometimes. They're very vast. Because of that, it creates cracks in normalized market conditions. That means that market will not go higher if it's under a heavy measure of distribution. It's not supply and demand. It's not indicator based. It's all based on liquidity. We can measure real buying and selling with what I just showed you today. And now by having the component of seasonal tendencies, you can sit back and literally wait certain periods of the year. You know you should be hunting a specific criteria or a direction or a setup. Now, once these setups take place, it doesn't matter if you're a long. I'm not a long-term trader. I can't trade, and hold for months. I tried it. I did it a couple times, maybe couple, not consistently, because my mental capacity for holding something long-term doesn't gel with me. I don't have the psyche for that. I'm a short-term day trader or short-term trader. But what I use this information is when I have these long-term prolonged moves.
It gives you the bias, what side of the market you want to trade.
Exactly. So I can work intraday or I can work with a weekly range and trade with that insight. So I'm not trying to be a long-term trader or force myself to do something. I'm just using the long-term insights to play off of.
Well, another great interview, buddy. Now, you're not the easiest guy to follow and get a hold of. If people want to follow you on Twitter, you have to vet them. You get a pending button. So what do? People request to follow you, and then you qualify them to see if you'll let them?
There's no qualification. I just like to see if actually watch it.
I didn't know if they had to be credited investors or anything like that. And do you have a website? I don't recall.
I do.
Yet. Okay, so maybe you could show it.
Well, it's theinnercircletrader.com. It's free. It's a free forum.
Okay.
Folks can go and watch all my tutorials. And there's some things in there that I'll be adding to over the remainder of this year that are free that you guys can go in there and just tinker around with it, watch. And there's a lot of things that you'll be challenged by, things that aren't really talked about.
You make people think, Michael. I like that. You're trying to give them a way to look at the jigsaw puzzle and put the pieces together and have be able to read markets, not just one candle.
Right.
So you're a natural teacher. You're a great guest, and I really appreciate you joining us for a return visit to F.A.C.E. And may pips rain down on you and your mentees till we meet again.
Thank you very much, sir. It's been a pleasure.
Okay, everyone, that's Michael Huddleston. You could find him on Twitter at I_am_ICT or go to his website. And that's a wrap. I'll see everyone for Turnaround Tuesday. Good hunting. And remember, don't just count your pips, count your blessings. Adios, everyone. See you tomorrow. Enjoy the rest of your day. Thanks again, Mike.